This QuickLearn Bullet summarizes the rules and calculations underpinning Basel I and highlights their key weaknesses and limitations. We begin by laying out the risk weights that apply to the various exposures. In the 0% risk weight category, we include cash, claims on or unconditionally guaranteed by OECD central governments, including central banks and government agencies. Note here that Iceland, Ireland, Turkey, Greece, and most of Eastern Europe are members of the OECD, while Singapore and China are not. So membership is not always a good indicator of credit standing. Next, claims collateralized by OECD government securities or cash. And finally, local currency claims on or unconditionally guaranteed by non-OECD central governments that are funded in the same currency. This rule was deemed necessary to avoid penalizing too heavily the local currency bond holdings of non-OECD banks, especially since those government holdings are considered critical to sound liquidity management. But holdings of this kind funded in a different currency do not benefit from the rule. In the 20% risk weight category, we have claims on or guaranteed by banks incorporated in OECD countries. The thought behind this rule is that banks have implicit or explicit support from their governments. So some tie between their risk weight and that of their government is appropriate. Next, claims on or guaranteed by other banks with a residual maturity of less than 1 year. These types of short-term claims benefit from a reduced risk weight given the critical role they play in short-term interbank funding. Next, claims on securities firms incorporated in the OECD and subject to comparable supervisory and regulatory arrangements, including in particular risk-based capital requirements as banks, and claims guaranteed by these securities firms. Note, however, that US regulators never accepted this rule and continued to apply a 100% risk weight to domestic and foreign securities firms, in contrast to banks. Next, claims on multilateral agencies such as the IBRD, i.e. the World Bank, the EBRD, the Asian Development Bank, or the African Development Bank, and claims guaranteed by or collateralized by securities issued by such agencies. While this rule does not specify clearly that securities means debt securities rather than equity securities, we believe it is intended to apply to debt securities only. Finally, in this category, claims on or guaranteed by OECD county, state, and municipal governments. This category includes the massive US municipal bond market, as well as financings guaranteed by these local authorities. Over in the 50% risk weight category, we have performing loans fully secured by residential property, residential mortgages, that is or will be occupied by the borrower or that is rented. But note, local regulators are authorized to restrict this rule as they deem appropriate. And lastly, in the 100% risk weight category, we have all other claims not qualifying for a lower risk weight, including especially claims on commercial enterprises, irrespective of their credit rating. Now, this category contains a huge percentage of typical bank exposures, including unsecured loans to corporates, loans to small and medium enterprises, loans to individuals, and even many secured loans where the collateral is not in the form of cash or securities or residential real estate, including, for example, loans secured by commercial real estate and by automobiles. Next on our list is the determination of credit conversion factors for off-balance sheet exposures. Again, these are classified in one of four categories, being the same 0, 20, 50, and 100% as before, which are now combined with the four possible risk weights to derive the risk-adjusted asset for each off-balance sheet position. In the 0% category, we have lines of credit, known as commitments, that can be unconditionally cancelled at any time by the lender. The thought here is that the bank can cancel the commitment to a deteriorating credit before it is drawn any further. Any amount previously drawn would of course have become a balance sheet asset, so would be treated in accordance with the rules we examined previously. We also have in this category commitments with an original maturity of up to 1 year. This rule is less easy to justify and in any event has been modified under Basle II. Its prior existence essentially reflected the reluctance of market participants and regulators to discourage banks from providing standby credit lines to backstop borrowers' commercial paper programs. Over in the 20% category, we have short-term self-liquidating trade-related contingencies, such as documentary letters of credit collateralized by the underlying shipments. This rule reflects the excellent payment history of this asset class, even in situations in which countries are experiencing distress and are defaulting on or rescheduling their other external debts. Over in 50%, we have commitments with an original maturity of over 1 year. This category includes the typical syndicated loan facilities extended to borrowers for various purposes, working capital purposes, for specific acquisitions, or any other purpose. Note again that any portion of the facility that has been drawn already counts as an on-balance sheet loan and is subject to the earlier rules. It is only the undrawn portion of the facility to which the CCF of 50% applies. The reason for applying a CCF of 50% only instead of 100% stems from the ability of the lender to invoke covenants and other conditions under the loan documentation to deny funding to borrowers whose credit is deteriorating. In this category, we also have note issuance facilities and revolving underwriting facilities. These types of facilities include a commitment by the bank to purchase notes or bonds issued by the borrower on predefined terms. So they are very similar in essence to standby credit commitments. And lastly, we have certain transaction-related contingent items such as performance bonds and so-called bid bonds. These are commitments issued by banks to support the payment obligations made typically by corporates in connection with construction and similar projects. If the corporate fails to meet a defined obligation with regard to the timing of completion or the quality of construction, for example, the counterparty can draw on the bank's commitment as a form of penalty imposed on the corporate under the contract. Lastly, in the 100% credit conversion factor category, we have direct credit substitutes, such as general guarantees of debt, including letters of credit serving as financial guarantees for loans or securities. This clause essentially treats credit guarantees as equivalent to on-balance sheet exposures. It prevents banks from achieving capital relief simply by guaranteeing debt held by another party rather than extending the debt directly. And lastly, in this category, we have the sale and repurchase agreements and asset sales with recourse, where the credit risk remains with the bank. This clause treats a sale with recourse as not a true sale at all and shifts back to the seller the credit risk of the asset sold. This leaves derivatives, for which Basel offers two alternative rules, but the more popular one converts the notional amount of each derivative contract into its current fair value plus an add-on factor specified in the rule, which reflects the potential future exposure over the remaining life of the contract and depends on two things: the nature of the underlying and the residual maturity of the contract. And again, these are combined with possible risk weights to derive the risk-adjusted asset for each off-balance sheet derivative. The add-on factors are listed in this table here and are pretty straightforward. But we bring your attention in particular to the very low entries for interest rate derivatives, even those with a long tenor, and also bring your attention to the separation of commodity derivatives into gold, which is treated like a foreign currency, other precious metals, and finally all other commodities. The so-called aggregate risk-weighted assets of the institution are now calculated pursuant to the following simple formula, which requires first that each asset on the balance sheet be multiplied by its specified risk weight, requires next that each item off the balance sheet be multiplied by its specified credit conversion factor, and then also by its specified risk weight, and finally requires all of these amounts to be summed together in order to produce the aggregate risk-weighted assets as a single number in units of currency. The total amount of eligible capital that the bank has is now calculated and separated into so-called Tier 1 capital and Tier 2 capital. Essentially, Tier 1 capital consists of common stock, retained earnings, certain types of perpetual preferred stock and hybrids, and some categories of reserves. And Tier 2 capital consists of certain other types of preferred stock and hybrids, some other categories of reserves, and subordinated debt that meets certain specified conditions. Finally, a bank must satisfy each of the following three conditions under Basel I. Tier 1 capital must be at least equal to 4% of risk-weighted assets. The sum of Tier 1 and Tier 2 capital must be at least equal to 8% of risk-weighted assets. And finally, Tier 1 capital must exceed Tier 2 capital. We conclude this chapter by pointing out certain weaknesses and inconsistencies of the Basel I regime. Number one, exposures to OECD countries in any currency other than the local currency, and only to those countries, carry a risk weight of 0, otherwise 100%, irrespective of the credit quality of the country. Point 2, all unsecured corporate exposures, and even all secured corporate exposures except for a limited category of collateral, carry a 100% risk weight, again irrespective of credit quality. 3, bank exposures less than 1 year long have a weight of 20%, irrespective again of credit quality or country of incorporation. 4, exposures to multilaterals like the World Bank and EBRD carry a higher risk weight, 20%, than those to Turkey, Greece, and Ireland, all members of the OECD. 5, credit lines, even committed ones, with an original maturity of 364 days or less, have a 0 CCF and therefore a 0 capital requirement. And finally, 6, residential mortgages for the most part carry a 50% risk weight, with no differentiation between mortgages based on different loan-to-value ratios or different underwriting standards. This completes this QuickLearn Bullet on Basel 1.